Fractional Reserve Banking. What is fractional reserve banking? In a system known as fractional reserve banking, only a portion of bank deposits are guaranteed by actual cash that is on hand and accessible for withdrawal. The idea behind this is to hypothetically boost the economy by making funds available for lending. Fractional reserve banking is used by the financial systems of the majority of economies today. Understanding fractional reserve banking. A certain portion of the cash that depositors pay banks must be kept on hand and accessible for withdrawal. If someone puts $100, the bank is unable to lend the full sum. Banks must now maintain the full amount on hand. In the past, several central banks have mandated that banks operating under their jurisdiction hold reserves equal to 10% of the deposit. One of the instruments the Federal Reserve uses to carry out monetary policy in the United States is this requirement. Money leaves the economy when the reserve requirement is raised, whereas money enters the economy when the reserve requirement is reduced. The necessary reserve ratio has traditionally been 0 for non-transaction accounts, like CDs, and 10% for transaction deposits, like checking accounts. But the Fed has also lowered the reserve requirements for transaction accounts to 0 in response to recent initiatives to boost economic growth. Fractional Reserve Requirements. The Fed must receive weekly or quarterly reports from depository institutions on their transaction accounts, time and savings deposits, vault cash, and other reservable commitments. A rate of interest on reserves known as the interest rate on reserves, IR, or the interest rate on excess reserves is paid to all banks, despite the fact that some banks are free from maintaining reserves, IOR. Banks are encouraged to retain extra reserves by this rate. In 1917, the Federal Reserve Act's reserve requirements for banks were established at 13%, 10%, and 7%, according to the kind of bank, respectively. The reserve ratio was established by the Fed at a maximum of 17.5% in the 1950s and 1960s for some banks, and it stayed around 8% to 10% throughout the majority of the 1970s through the 2010s. Banks with assets under $16.3 million were exempt from holding reserves at this time. Banks were required to maintain 3% reserves for assets under $124.2 million but greater than $16.3 million, and 10% reserves for assets beyond $124.2 million. The 10% and 3% statutory reserve ratios against net transaction deposits were cut to 0% for all banks as of March 26, 2020, thereby eliminating the reserve requirements completely. The National Bank Act of 1863 mandated 25% reserve requirements for U.S. banks under its supervision before the Fed was established in the early 20th century. Fractional Reserve Multiplier Effect. The portion of deposits retained in reserves is referred to as a fractional reserve. For instance, a bank must retain $50 million, or 10% of its assets, in reserve if its total assets are $500 million. When calculating the effect of the reserve requirement on the economy as a whole, analysts use a calculation known as the multiplier equation. The initial deposit multiplied by 1 divided by the reserve requirement yields the equation, which offers an estimate of the amount of money produced under the fractional reserve system. Using the aforementioned example, the figure is $500 million times 1 divided by 10%, or $5 billion. This is only a means to illustrate the potential effects of the fractional reserve system on the money supply, not how money is really generated. As a result, although it is beneficial for economics academics, politicians typically consider it to be oversimplified. What are the pros of fractional reserve banking? By using funds that would otherwise be underutilized and idle, banks may create returns in the form of interest rates on new loans and increase the amount of money that is available to support economic growth. As a result, it may more effectively distribute cash to areas where it is most required. What are the cons of fractional reserve banking? In the self-reinforcing panic of a bank run, fractional reserve banking might leave a bank short on cash. When too many depositors want their money at once but the bank only has, say, 10% of deposits in liquid cash on hand, this happens. Because too many clients tried to withdraw assets at once during the Great Depression, several U.S. banks were forced to close. However, fractional reserve banking is a widely used business method in banks all over the world. Where did fractional reserve banking originate? Although its exact beginnings are unknown, fractional reserve banking is unquestionably not a recent invention. In the Middle Ages, it was believed that goldsmiths would issue demand receipts for more gold than they really had on hand because they knew that only a tiny portion of that gold would ever be required. Fractional reserve banking was first used in modern times by Sweden's Riksbank in 1668. Thank you for watching. Please like, share, and subscribe.